The velvet tax trap is a term that describes the situation where amateur landlords end up paying more tax than they expected on their rental income. This can happen because of the way the tax system treats rental expenses and capital gains. In this section, we will look at some strategies that can help you avoid or minimize the velvet tax trap by using interest-only loans, depreciation deductions, negative gearing, and tax planning. One strategy is to use an interest-only loan to finance your rental property. This means that you only pay the interest on the loan and not the principal. This reduces your monthly repayments and increases your cash flow. It also means that you can deduct the full amount of interest as an expense against your rental income, lowering your taxable income. However, this strategy has some drawbacks. You will not build any equity in your property and you will have to repay the principal at some point. You will also pay more interest over the life of the loan than if you had a principal and interest loan. Another strategy is to claim depreciation deductions on your rental property. Depreciation is the loss of value of an asset over time due to wear and tear. You can claim depreciation on the building structure and the fixtures and fittings of your rental property, such as carpets, curtains, appliances, etc. Depreciation deductions can reduce your taxable income and increase your cash flow. However, you need to be aware that depreciation reduces the cost base of your property, which means that you will have a higher capital gain when you sell it. You will also need to get a depreciation schedule from a qualified quantity surveyor to claim depreciation deductions. A third strategy is to use negative gearing. Negative gearing is when your rental expenses are higher than your rental income, resulting in a loss. You can deduct this loss from your other income, such as wages or salary, reducing your overall tax liability. Negative gearing can help you offset the cost of owning a rental property and benefit from capital growth in the long term. However, negative gearing also means that you are losing money on your rental property and relying on future capital gains to make a profit. You also need to have enough other income to cover the loss and pay your living expenses. A fourth strategy is to do some tax planning. Tax planning is when you arrange your financial affairs in a way that minimizes your tax obligations within the law. For example, you can choose the timing of your rental income and expenses to optimize your tax outcome. You can also structure your ownership of the rental property in a way that suits your situation, such as using a trust or a company. You can also take advantage of tax concessions and incentives that apply to rental properties, such as the capital gains tax discount or the small business CGT concessions. However, tax planning can be complex and risky, so you should always seek professional advice before making any decisions. These are some of the strategies that can help you avoid or minimize the velvet tax trap by using interest-only loans, depreciation deductions, negative gearing, and tax planning. However, these strategies are not suitable for everyone and they have their own advantages and disadvantages. You should always do your own research and consult a qualified accountant or financial planner before investing in a rental property.